Wealth Our Way Wednesdays, 12:30 p.m. 15 minutes of finance. What do you do when you're starting from the mud with less than zero? No plan, no role model, no hero. Take to the streets, bring heat like De Niro, or tune in the wild, the network, the thorough. If it was me, I'd sit down with a pad and a pen, hit my homie shitty thoughts with a friend. Tank is spitting real knowledge from beginning to end. 15 minutes, Wealth Our Way, let the lesson begin. Yeah, 15 minutes of finance with your man, Big Tank. Let's get it. What is going on, my people? It's your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. I was traveling last Wednesday and could not broadcast, and it leaves me with just one question. Did you miss me? I missed all of you, and I'm so excited to talk to you today about what's been going on in the banking environment. We're looking at what many consider the beginning of what could be another financial crisis like in 2008 when our venerable financial institutions came under, I would just use the word attack, because people started to lose confidence in the financial system and started to withdraw their money in such a way that the banks did not have liquidity on hand to meet. And this just exasperated the concerns that people were having. It's like a self-fulfilling prophecy. You worry that your money is there, so you go to snatch your money. Banks are never actually prepared with the amount of money on hand that represents all the people who have money at the bank. So then it creates an illiquidity moment where you don't have enough money to meet the request of your depositors, which only goes to reinforce to the depositors that things are bad, and that makes them make a bigger run on the bank. So today we're going to talk about whether banks are still a safe place to keep your money. And I'm going to do a great job. I'm going to tell you ahead of time. I'm going to do a great job of not showing my personal disdain for the banking institution. Because any of you who have followed me for the last 3 years know I'm not a big fan of the banking industry. And since I have delved into cannabis in New Jersey, my disdain for the banking industry has only grown. But I'm going to do a good job today of putting that to the side and talking straight facts to you. But before we get started on today's episode, you know we always got to jump into go or no go. Today's question, I picked out of a bunch of questions something that stays in tune with what we're doing on the Financial Power Hour this month, which is talking to two tax professionals because it is tax season. Some of you have already filed your taxes. Others have not. Others, like myself, wait to the very last possible minute to file our taxes. Everybody is different. Everybody has a different need and a different reason. Today's question centers around whether or not it is a good idea to maximize, increase, I even dare say, lie about the number of withholdings and exemptions that you report when you get a job or to your human resource department. So you fill out a document when you start working at a new place that tells them how they should send your taxes to the federal government, how they should withhold from your check. It's a balancing game where you give them this information, they withhold a certain amount of money, they send it to the IRS. This is, taxes in America are due as you earn your money. Most people don't understand that because we file taxes at the end of the year kind of as a scorecard. But taxes are due when you earn your money. So that's why those of us who have jobs, and I say jobs, not like those of us who run a business and maybe don't have a job, we just are the entrepreneur. But those of us who have jobs, our jobs will withhold a portion of our paycheck, send it to the IRS. And when we file our taxes at the end of the year, we're just balancing the books. We're getting back if we paid too much during the year. We're paying in if we didn't pay enough. So that amount that they withhold is determined by this withholding form that you fill out. And some people do it honestly. They are a single person living by themselves, and they'll put one withholding, one exemption. Other people know the tax game a little bit, and they'll say they got 11 exemptions, 20 exemptions, something crazy. the more exemptions that you list on the form, the less money gets withheld from your check. So people say, hey, I want my money up front. I want to be able to use it. Then at the end of the year, if I owe, I'll send the government the difference. That is not a bad idea if you are responsible financially and can make sure that you don't run into a situation at the end of the year when it's time to pay your taxes that you are short, because now you will be hit with all types of penalties and interest. And I can guarantee you, a word that shouldn't be used very often in finance, but I can guarantee you that the penalties and interest that you'll pay by not paying your taxes on time will exceed any benefit that you received by getting use of your money earlier. So the person asked me, should they falsely inflate their exemptions or withholdings? And I'm going to say that is a no-go. So one of the things we got to do, producers, we got to get a no-go emblem and a go emblem. And when I say no-go, something fly need to pop up. And when I say go, something fly needs to pop up. But this is a no-go. Don't falsify your exemptions and withholdings. Try to play it as close to the vest as possible. Make the best use of $1 all year long and settle up your taxes at the end of the year. So let's roll into today's episode, because now I done talked a long time about the go or no go, and I'm going to speed through the banking situation real quick. My man Brew asked, can I give a quick breakdown on how the run on banks hit the stock market and how I feel about that? It'll have to be quick. What I would say is this: consumer confidence runs our entire financial system. Banking, the markets, everything that we deal with, it's based on consumer confidence. The individuals that are in the market, you, me, everyone else, we determine whether we feel things are good or whether we feel things are bad. And based on that sentiment on how we feel, the economy normally will reflect those feelings. So they have an economy, you have things that are known as leading indicators and lagging indicators, things that happen in the economy because of how people feel or things that they've already done. When you see something like the banks giving trouble, missing deposits, not able to keep their doors open, almost everybody has a bank account. Almost every, we're talking about people who are above the poverty line. They have bank accounts. So more people are affected by banking than they are the stock market, because far more people have bank accounts than people who invest in the market. With that being said, this influence of what people do, whether they spend money, don't spend money, because you have to understand the stock market reflects earnings of companies. So if people stop spending money because they're scared their money's going to go away, they'll stop spending. Stores will have lower sales. They'll miss their earnings projections. If they miss their earning projections, the stock will take a hit. So the banking crises, whether we're going into a full-fledged one or we're just kind of dancing around the outside of it, it affects the stock market because it makes people think things are bad. And when people are thinking things are bad, there's a flight to safety. The stock market is not deemed to be the place where you go for safety. It's where you're willing to take a little extra risk to get a little extra return. So when you're concerned about safety, the market gets hit badly because the market is a supply and demand type of situation. If I put more money in the market, people are investing, they have more money in their pockets, then the prices are going to go up because people are buying. Conversely, if people are scared, they're worried about the economy, they're not buying, or they're liquidating stocks, the market will go down. So the short answer, and I don't ever give a short answer, but the short answer for how the banks negatively affected the market is that consumer confidence, the average citizen in America thinks there's a problem. And so long as the average citizen thinks there's a problem, they're going to be tight to the vest with their money. In periods of contraction and tightness of money, the market is negatively affected. I hope that sufficiently answers my question, my man Big Brew's question. And happy belated birthday, Brew. I hope you got busy this past weekend enjoying yourself for your birthday. So let's roll into what actually happened with these banks. We're talking about two banks in particular, Silicon Valley Bank and Signature Bank in New York. These aren't huge conglomerate banks and not your Bank of America or your Wells Fargo, but Silicon Valley Bank had some significant deposits in it because it was the banking destination of choice of a lot of the Silicon Valley startups in the tech business. So a lot of tech companies failed to segregate their accounts at that $250,000 limit that the FDIC will insure you on. And they had more money in their account than can be covered. The FDIC, because people don't really understand what the FDIC is, it's the Federal Deposit Insurance Corporation. It's a private company. It's an insurance company. It's not the federal government. It's the company that the government allows to provide insurance to all of the depositors. But there are way more deposits. There's way more money in banks than the FDIC even has in its coffers. So if the banking industry truly goes belly up, the FDIC doesn't have enough money to insure all of the accounts that it claims it is insuring. That's a whole nother problem. What we're seeing as a result of these particular banks having a run is now we're looking at the reserve ratios of the bigger banks, of the banks that we deal with. And here's how I would tell you to protect yourself in the event of a banking crisis, and also how to maximize your relationship with your banking institution. And I'll tell you that through 3 tips. Tip 1. The first thing you need to do when you're dealing with banks is not put all your eggs in one basket. You have heard this before. I particularly, and y'all know 3 is my favorite number. So there's 3 tips, there's 3 everything. So don't take it, as gospel that it has to be 3. Maybe it's 2, maybe it's 4. For me, I use 3 banks. I want a credit union. I want a local bank that's small that I have a good relationship with. And then I want a national, even global bank because I travel. Having these 3 different banks allows me the flexibility of the services and products with each bank. When one says no, the other may say yes. It allows me also to stay under that $250,000 deposit limit that the FDIC insures, because Big Tank got money, but he ain't got that much money where I got over $250 in 3 separate banks. Tip 2, never exceed the FDIC coverage limits. Now, this is something that some of you are like, dude, I ain't got to worry about that. $250,000 is not, something that I would have in the bank. I understand that. You understand that the clientele that I have range from mom and pop Americans to super wealthy retired athletes, C-suite executives, small business owners. And some of them do have millions of dollars that they don't even have at their brokerage account that they want in the bank for liquidity reasons. When that is the case, I have to develop a plan to make sure that they are staying under the coverage limits so that if the bank does have a run, I can get them covered. Tip 3. Maximize your interest that you're receiving from your bank, minimize your fees. This kind of plays right back into tip 1. Every bank has fees. Every bank pays interest in some account or another. It is your job. Unfortunately, it's not easy. It's not quick. It's your job to look at the offerings that the different banks have and make sure you're getting the most on your savings, that you're taking advantage of free money offers. I just got an email today from Capital One telling me that if I put money into a new savings account, I'll earn 3.9% and I'll get cash if I keep the money in the account for at least 90 days. I'm going to look into that offer and see if it makes sense for me because I love free money. So those are your 3 tips. Use 3 banks. Never exceed the FDIC coverage limits. Maximize your interest. Minimize your fees. With that being said, I want to thank you all for being here. It's going to be an amazing Wednesday. Next Wednesday, I'm back with 15 Minutes of Finance and the Financial Power Hour. You cats have a great day. Thanks for tuning in to the Wild Network. For more great content like this, be sure to subscribe to our YouTube page at Wealth Our Way Network. Also, don't forget to follow us on IG and Facebook. Remember, wealth is not only for the wealthy.